Program is brought to you by IG. Trade over 12,000 shares and ETFs, including major tech giants with extended hours on an award-winning platform. IG, where traders are made.
And our stock of the day is GQG Partners. It's updated its funds under management, which amount to $150.1 billion US dollars at the end of May, up from $142 billion the previous month. It experienced net inflows of $9.1 billion for the year to date. And after its first quarter result, it anticipated continued momentum through the year, given what it said was a reasonable pipeline of client demand. So checking in on the share price today, having a reasonable bump, up more than 2.5% at this point. All right, well, let's get some analysis on that stock. And Mark, I'm going to start with you because interesting, on yesterday's show we were talking in the fund space with Magellan, which you're pretty negative on. You mentioned this stock. Why do you like it?
It's really the new model for funds management overall. Those those archaic models whereby I think have really being replaced by the ETFs overall, and someone had to start to make changes to how funds management operations were done. So, and GQG is really one of my favourites. The more I read into it, they've got characteristics of a business there where it's the majority of it's owned by its employees. Their employees invest heavily in their own products. That's a massive tick, and I think it's something that is really lacking in a lot of the old school fund offerings. They're a little bit unique in terms of, instead of having a floor full of equities analysts, they've got people like investigative journalists and geologists and things on staff, where people who have got actual real world knowledge and wisdom in their fields, rather than someone with an economics degree making an assumption based off a model. So I think as obviously AI continues to improve and be more widely used, I think that old equities analyst role is largely going to be replaced by aggregators like ChatGPT. And they're obviously being, having some skin in the game from all their key staff. Obviously, the high commitment to risk management. And very client-centric approach. So it's, at MPC, for instance, the whole reason we started it was we wanted to have a very client-centric offering, that actually catered to the customer's needs, rather than just being, financial industry's got a bad habit of just, telling you what you need rather than asking. So, and these guys have got all those characteristics. Their performance has been fantastic as well, and that's where it's a popularity contest in funds management most of the time. And these guys are, they're top of the pops at the moment, and I would absolutely expect this, this fund inflows to continue. So I think their US equities funds up something ridiculous like 50% in the last year or more. And very strongly beating their index.
So I'm assuming that is a buy from you.
Yeah, absolutely. I think this has got, if they stick to their their ethos, I think it's a really solid platform for them to continue to grow, because customers will always be attracted to something that's in their interests, rather than someone who's just taking fees.
All right, Luke, what are your thoughts? Because fund management, it has been a difficult space, as we've seen with the likes of Magellan. So do you agree with that?
I do, Andrew, and Mark hit on some key points there. It's not one I looked at too closely, so taking a bit of a closer look today, you quickly realise, these guys are fund managers, but as Mark points out, they do it a little bit different to your traditional managers. So they probably compete more with your low-cost options like ETFs. They only charge on average less than 50 basis points. It's a far lesser amount than most boutique managers who are around that sort of 150 or 200 basis points. And there's far less reliance on performance fees. Over the last couple of years, performance fee revenue as a total has sort of been between 2 and 4%. They're very much focused on the management fee behind the business, and rather than trying to shoot the lights out and try and hit performance, it probably ties into what Mark said about really looking out for that end customer. Look, at the end of the day, they are a fund manager. I do agree they do it a little bit different. So that old caveat of you want to see that fund manager with those inflows, but these guys have that. I mean, this result here today, it's their biggest monthly inflow. I went back sort of 5 or 6 months. It's their biggest monthly inflow in that time. So it's not even like it's slowing down. If anything, they're at 150 billion and getting faster. Their strategy, it is primarily equities. At some point, they sort of hit their head on the ceiling. You can only take that strategy so far. Can they pivot to fixed income? Can they pivot to private equity, maybe some other asset classes? But that's probably a conversation for down the road. I tried to annualise some numbers. It's hard to do. Obviously, you need to know the fund coming in, where it's going to, and all that sort of stuff. But I sort of came to about 12 to 13 times earnings, which is a pretty fair price for these managers. That's where they should trade. But to that point before, they're still growing strongly. They're doing the right things. And I think they really market themselves and put themselves in a very interesting competitive position, particularly compared to other active managers. So I'll say a buy as well. I think these guys are doing really well at the minute.
Terrific stuff. That is a double buy then for stock of the day, which is GQG Partners. Mark there, we're both talking about the fact that it is a new model, and it's doing it a little differently to the others. So double buy there for our stock of the day, GQG Partners.
This program was brought to you by IG, Australia's #1 CFD provider. Trade over 17,000 markets with extended hours on key US shares and competitive spreads. All on an award-winning platform. IG, where traders are made.